The first question was, why did so few see it coming, and why did the BIS, as one of few, see most of it? I think the answer, and the government, I think, rightly pointed out that there are a lot of those who claim today that they saw it coming, who I have difficulties in finding the scriptures in the past which suggest that they actually saw it coming. I think the difficulty was that it was a mixture of all these things which came together, as I explained. I think if there had been one single cause, it would have been much easier to identify. I think there were a few, very few, who I think can claim that they saw important parts of it. I think in addition to the BIS, I think Bob Schiller was one of those who have, in fact, not only seen one bubble, but two bubbles, which I think is pretty impressive for an economist. I think Bob Schiller, and to some extent the BIS, shares something, and the BIS, it's particularly Claudio Borro and White. I think they share the thing that they mix the understanding of finance and how financial markets work with the macroeconomy. I think the problem for most economists in central banks, in the European Central Bank, at the IMF, was that they were primarily macroeconomists. And as macroeconomists, I mean, you work with sort of the demand side of the economy, and even in the most important paradigm, Michael Woodford's neo-Keynesian paradigm, in terms of sort of which everybody believed in, had the financial sector as a residual, something which couldn't generate problems. It was a beautiful mathematical model, but it just did not show what happened. And I think the BIS and Bill White's and Borro's advantage was that they tried to link finance with macro, which was very unfashionable. I think the ECB should have been closer to it, because actually there was some focus on monetary and credit developments, but I think they looked at the wrong thing. They looked at money instead of credit. So I think that would be my sort of very brief sort of that somehow you need to combine a lot of things in order to create that risk picture, and it's incredibly difficult. There are really great minds which failed. You know. I think when it comes to the second question, which was conglomerates and banking, I actually think that we will see smaller banks. We'll see banks retreat. We'll see few global banks. We'll see banks which will be managed incredibly tightly. I mean, they will have to have very high capital requirements. The supervisors will be sitting on them. Central banks will be sitting on them. They will not have the degrees of freedom they had before. I think we might go back to what you could call the safe banking. I can't remember the story. It was something about 9-3-4, where sort of you come in at 9, you leave at 3, and then you're at quarter 4 or something like that. You might have that kind of banking. At the same time, I think that you can't put financial engineering back in the box. In fact, to some extent, we need it. I mean, the moment we constrain banks, we need other sources of finance. And I think that there will be a lot of financial engineering on the side. I think the shadow banking sector, which has been big in the US, which also become big in Europe. And some of it we need. I mean, we need corporate bonds if we are to finance the industry when we put a lid on banking. So we are torn between two lovers, as the song says, in terms of, on the one hand, wanting to constrain risk, and on the other hand, having to generate finance for the economy, which inherently generates risk. Other questions?
Okay, so you partly answered the question by my first question by explaining that the industry would basically be funded by other institutions than banks, but you did not answer the second question that I would like to ask. Why would someone put his capital into a bank that would have the asset side full of liquid assets, because they would not bring any better return than for the depositors who put the liquidity into the bank?
I think that's a very valid concern. I think it sort of goes to show that, I mean, there's a significant risk that even if we want to recapitalize banks, we won't be capable of doing it. I mean, if I sort of often ask the question to people who say, well, I mean, raise solvency requirements dramatically. I say, yeah, I mean, if I could get there, I would like to go there. But think of yourself in terms of your pension savings. I think the latest EBA estimates in terms of what the banks needed just to get to 10.5, and I think they need to go significantly above that, was around 500 billion for the euros for the largest banks. That's about 50% of the market cap of these banks. Ask yourself, in terms of your pension savings, what would you say to your investment manager if he allocated 50% more to banks? An industry which is likely to have, as you say, very low return on equity, and a future which is not necessarily that promising. So I think the inherent logic I understand in terms of moving from one equilibrium to another, but I think that moving from these equilibriums will be very difficult because, as you say, who will invest in banks? And I think that at some stage, we'll be faced with that trade-off between generating finance for the rest of the economy through some other sources which might be risky in themselves, or generating it through banks. So I very much agree with you.
Jesper, my first question, the gap in productivity of labor between the south and the north of Europe and Denmark is estimated at least 20%. How to change the situation in monetary union?
Yeah.
And second question, European Commission is just launching its new initiative to limit bonuses for bankers. What do you think about that?
On the first question, how do we get Southern Europe up to the same productivity levels as Northern Europe? I don't think we will be capable of doing that. I think that in the discussions on the fragility of the economic and monetary union, there's often just a focus on fiscal positions. I think fiscal positions you can resolve. You can do debt restructuring. I think the big issue is the competitive disequilibrium. I think the way in which we are right now trying to adjust the competitive equilibrium is by moving out the Phillips curve, by putting pressure on unemployment, which puts pressure on wages, and eventually we'll get there. But that is really a rough trip. And as the elections initially showed, that is not a trip the voters are very happy to undertake. The only alternative, obviously, is to do it fast via introducing flexible exchange rates. That is a tumultuous step to take, a step which could cause a huge crisis, but which would be a one-off. It would also result in a huge adjustment of living standards, but it would be quick. It would be much quicker than the other alternative. But right now we seem to be focused on doing it through moving out the Phillips curve, trying to do a lot of structural reforms, which hopefully can generate some growth, but where we've been disappointed in terms of its effect thus far. The second question on the bonuses. I very much understand the reaction of the man on the street. I think it's extremely legitimate. I think in the financial sector, we have to understand that we have to do something dramatic to rebuild. I don't think sort of putting the restriction on bonuses makes a lot of sense in economic terms, because I really think bonuses is a very flexible tool of allowing people sort of to move up and down salaries depending on how they perform. But that seems to be the requirement of the man on the street and the politicians representing the man on the street. So I think, if that is what it takes in order to help restore confidence, I think we have to bite the bullet and live with it. I don't think it's a smart move, but if it helps politically, let's live with that and see how things develop. Okay, thank you.